Owning a car is the #1 wealth killer in the US. Financial experts love to repeat this one over and over again. But what if I told you they're only telling you half the story? Imagine blaming the match for the house fire when it's actually the gasoline that made everything explode. I'm here to tell you it's not the car. It's something else that quietly drains your wealth month after month. So today, let's uncover the real #1 wealth killer no one's really talking about. And more importantly, how you can break free from it. You've probably heard it over and over again. Cars are the #1 wealth killer in America. And on the surface, it sounds true. Cars lose value the moment you drive them off the lot. They come with maintenance costs, insurance, gas, repairs, all expenses that add up over time. So yes, cars can drain your finances if you're not careful. But here's where things get oversimplified. Many financial experts focus on the car itself as the problem, as if owning a car automatically destroys your ability to build wealth. And that's only half the story, because here's the thing. If you own your car outright with no loan, the financial burden is completely different than if you're making high interest payments on it every month. In other words, it's not the car that's the real problem. It's the cost of borrowing money to buy the car. The interest you're paying on that loan month after month, often for years. When experts say cars are wealth killers, they're pointing to the visible, easy to blame object, but they're missing the deeper issues that are actually draining your money. And that issue isn't limited to cars at all. So if it's not the car sitting in your driveway right now, let's talk about what's really killing your wealth. It's the high interest debt attached to it. If you took out a loan to pay for that vehicle, when you take out a loan, whether it's for a car, a credit card, a student loan, or even a mortgage, you're not just paying back what you borrowed, you're also paying interest on top of that loan. And depending on the interest rate, that can add up to thousands or tens of thousands of dollars over time. Let me give you a concrete example. Let's say that you have $5,000 in credit card debt. According to Forbes, the current average interest rate on credit cards at the time that I'm filming this video is 28.72%. So if you're only making the minimum payment, which we'll say is around $120 a month, you'll end up paying over $21,000 in interest just to pay off that $5,000 balance. Quick note that I want to mention here. I used 3 different online calculator tools to run these numbers, and each one gave me slightly different results for the total interest paid, and it ranged from $21,000 to $24,000. So this calculation is accurate within about $3,000 margin of error, but it's not perfect. I stuck with this one simply because it gives an easy way to show the option of making an extra payment, which we're going to talk about in a moment here. So yes, $3,000 is a meaningful amount of money, but remember, we're just running a simulation here to illustrate the bigger point about how high interest debt quietly adds up over time and eats away at your wealth. The exact number might vary depending on your situation, but the lesson stays the same. And if you want exact numbers for your own situation, I recommend just reaching out to your lender to get a clear breakdown of your balance, your interest rate, and your payoff schedule. That way you can see exactly how much your debt is costing you and how much you can save by paying it down faster. Okay, so back to our example. Think about this. You borrowed $5,000, but you're paying back more than 4 times that amount, over $21,000 just in interest. And here's the painful truth most people don't realize. The higher interest rate, the more of your payment goes toward interest, and the less goes toward paying down the actual balance. So even if you're making your payments on time, you might feel like you're barely making a dent because most of your money is just going straight back into the lender's pockets, not reducing your debt. This is what quietly drains your wealth. It's not just that you have debt, it's that the cost of carrying that debt eats up money you can be using to save, invest, or just build a stronger financial future for yourself. And here's the real truth. It doesn't matter what that debt is attached to. It could be a car, it could be a credit card, it could be student loans, it could be your mortgage. It could be even the buy now, get it later agreement that you signed up for to get something you really wanted right now. What matters most is the interest rate you're paying. The higher the interest rate, the more money you're losing over time, and the less you have to put toward things that actually grow your wealth. And now here's where things get even more dangerous, and it's something most people don't even realize is happening. It's not just one high interest loan that drains your wealth. It's when you have multiple high interest debts stacked on top of each other. So let's take a look at what's really happening with the interest on these loans. So credit cards. We already said that $5,000 on a credit card at 28.72% interest is with only minimum payments of around $120 would end up costing you $21,807 in interest, and it would take you about 20 years to pay it off. So with a car loan, let's say that you owe, say, $13,000 and your interest is, say, 10%, and you're paying $250 a month on the payment. So at that rate, you would end up paying $4,052 in interest, and it would take you just under 6 years to pay it all off. Okay, and next let's take a look at, say, maybe you got a personal loan, and we'll say that you owe $3,000 on that personal loan, and your interest rate is 7%, and you're making payments of, say, $75 a month. So over time, you would be paying $420.53 in interest, and it would take you almost 4 years to pay it off. Now here's where it all adds up. If you look at these three debts together and you don't make any extra payments over the course of 20 years, because that's how long it'll take to pay off the credit card with just minimum payments, you'll end up paying around $26,279 in interest alone. Combine that with the original $21,000 you borrowed across all three loans, and you're looking at a total cost of nearly $50,000 just to pay off $21,000 worth of debt. That's the multiplier effect in action. It's not just the debt you owe, it's the combined drain of multiple debts stacked together, pulling money out of your pocket month after month, year after year. And this is why so many people feel stuck. Even though they're making payments on time, they're losing massive amounts of money to interest, and it's keeping them from ever getting ahead. So at this point, you might be wondering if the debt itself isn't the only problem, what actually matters the most. And here's the key. It's not just about what you owe. It's about how your loan is structured and how you managed it. There are three things that matter the most. Your interest rate. This is the biggest driver of how expensive your debt becomes over time. The higher the rate, the more you pay in interest, and the longer it takes to pay down your balance. Even a few percentage points can make a huge difference over the life of a loan. Your loan term. This is how long you've agreed to pay the debt back. Longer terms might lower your monthly payment, but they often increase the total interest that you pay over time. Shorter terms can save you money overall, but require bigger payments every month. And last is your repayment strategy. This is where you have the most power. Are you only making the minimum payments, or are you prioritizing extra payments towards your high interest debts? The choice that you make here can dramatically change how quickly you get out of debt and how much you save in the process. Look what happens when you double the payment amount on that $5,000 credit card balance that we've been talking about. Instead of just paying the minimum $120 payment, you decide to pay $240 every month. Instead of paying over $21,000 in interest, now you're paying just $3,600. And don't get me wrong, that's still a lot of money, but it sure beats what you'd be paying if you were only making the minimum payments. That's the power of your repayment strategy. It can dramatically reduce the cost of your debt and speed up how quickly you can free yourself from it. When you focus on those three areas, your interest rate, your loan term, and your repayment strategy, that's when you start taking control back from your debt and opening up space to actually build wealth. And now that you know how much your high interest debt is really costing you, it's time to start thinking about what you're going to do about it. But here's a big question. Is it enough just to focus on paying down your debt? Or is there another strategy you can use to not only wipe out your debt, but also to start building wealth at the same time? If you're ready to explore the bigger picture, watch this video next.